I will give the introduction of Uchit Bhai Sheth, and it is my honor to give introduction of Uchit Bhai Sheth because in a very young age he has achieved milestones in his life. He is successfully practicing advocate as a High Court and in Supreme Court in GST matters and all other legal matters. And we feel proud that Uchit Bhai is among us, and Uchit Bhai is author of sales tax agenda for many years, and he is article writers in many more journals. So we are proud that Uchit Bhai is with us, and today's topic is really suited for Uchit Bhai because we need much more explanation and clarification in input tax credit, because input tax credit is the core thing of GST, and if we learn it by the expert, then it will be a very much win-win situation for us. With this introduction, I humbly request Advocate Uchit Bhai Sheth to start with his session. Uchit Bhai, please. I request all the other panelists to please switch off their videos for better clarification. Thank you.
Will I be able to share my screen?
Yes, sir. You have a share screen option. Vishwesh bhai.
Bol Karthik.
Okay, fine.
Good morning, good evening, everyone. On this rainy evening, at least here in Ahmedabad, we are going to try and analyze and understand one of the most important aspect of any indirect tax regime, that is tax credit. Before we go to specific provisions, let us first try and understand what is the nature of tax credit. We are not talking about GST credit only. We are also talking about credits which were available under the earlier regime, under the VAT regime, under the excise regime. Let us first try and analyze what is this tax credit. It is common knowledge that in a value-added tax scheme, the tax which we pay on the purchase side, the input side, is commonly referred to as the input tax credit. So if I have a liability on the sales side or the supply side, then to the extent I have already paid the tax on the input or the purchase side, I have a lesser tax liability. But from the legal perspective, the question is whether I can claim the credit of the tax which I paid on the purchase side or on the input side by way of a right, or whether this credit is a form of a concession which is given by the legislature. Here we need to understand that while tax credit is a right, it is a right which is arising from the statute itself. There is no right which is there beyond the provisions. So suppose if we take the example of GST law right now, suppose tomorrow the legislature deems it fit to delete section 16 absolutely from the statute book, then we cannot say that, look, I have already paid tax on my input side, please give me the credit of that tax. We have no right which is independent of the provisions of the very act itself. So to answer the question, it is a right, but it is a right arising out of the statute, and therefore it is also a form of a concession which is given by the legislature. So if the legislature does not give that concession, we cannot find fault with it and say that no, because I have already paid that tax, kindly give me credit. That tax is paid by us to our vendor on our inputs. Our tax liability is on the supply which is made, to be made or made by us. So if the government says that no, forget about the tax you paid on your input, you pay tax afresh on the supply or the sales side, no fault as such per se can be found with the legislature. But to further add on, once that right is given by the statute, then it cannot be taken away very easily. So suppose right now today, the section 16 is existing on the statute book in the GST law. I am entitled to claim input tax credit of the tax paid on my purchases. I arrange my affairs accordingly. One fine day, the government cannot come up and say that no, forget about that tax, we will take away that credit with a retrospective effect. That has been laid down in a number of judgments to be not permissible. So it is a concession given by the legislature, but once that concession is given, is granted, it becomes my right, and then that right cannot be easily taken away. So to understand this principle, just let us analyze a couple of judgments of the Supreme Court. In the slide, I have given citations of 4 judgments. First 2 judgments are very famous landmark judgments under the excise regime, Eicher Motors and Daiichi Karkaria, where again, insofar as Eicher Motors is concerned, the credit was admissible under the statute. The rule-making authority or the delegated legislation, one fine day said that no, forget the credit, we'll lapse the credit. Supreme Court said it is a vested right, the credit which was already accrued to the assessee, that cannot be taken away by the rule-making authority. Per contra, if we look at the judgment at serial number 3, State of Gujarat versus Reliance Industries Limited, this was a judgment in the context of the Gujarat Value Added Tax Act. Question was regarding interpretation of the input tax credit provision under the VAT Act, and in that context, the Supreme Court said that input tax credit is a sort of concession, and therefore if the legislature wants to impose a condition or a restriction against availment of that input tax credit, it is open for the legislature to do so. So while at first glance it may appear that there is a slight conflict between these 2 propositions, as such there is none. Legislature can impose conditions for availment or utilization of input tax credit, but once we satisfy the condition, we are entitled to the input tax credit, then subsequently the legislature cannot take the credit away. This analysis or this understanding will be useful when we move forward and analyze the other specific provisions of the GST law. So with this, let us move to the specific provisions. First and foremost, Section 16, subsection 1 of the GST Act is the parent provision for grant of input tax credit. I have just taken out a brief extract of that provision. It says that credit is admissible of input tax charged on any supply of goods or services or both to him, which are used or intended to be used in the course or furtherance of his business. So unlike the previous regime under the excise and VAT, where we were required, insofar as manufacturing business was concerned, we were required to establish a link between the raw materials and the services and the manufacturing process per se. There were a lot of litigations on that aspect, whether a particular commodity like say fuel can be said to be used in the manufacture of a finished product, whether consumables can be said to be used in the manufacture of finished products, and there were a number of judgments on that aspect. Fortunately, now under the GST regime, at least the parent provision per se is quite simplified. The foremost condition is that the goods or services should be used in the course or furtherance of business. So I don't need to prove whether they are used in manufacture, whether they are directly used in business or not, whether they are indirectly used in business or not. If they are used in the course or furtherance of business, then the goods or services primarily are admissible for input tax credit. So the phrase or the words used are course and furtherance. So if you look at the dictionary meanings of these words, they say they are more or less similarly defined. It is a way of development of something. So anything which per se is used in the development of my business, that would be in the course or furtherance of my business. Next, it is important also to understand that the term business is specifically defined under the GST law in section 2 subsection 17. If we peruse the definition of business, it is very widely worded. So business is defined to include any trade, commerce, manufacture, etc. It also includes anything which is incidental or consequential to my main business. It also includes anything which is done in relation to commencement or closure of business. So business is also widely defined. So the provision per se is wide. The definition of business is also very wide, and therefore the scope of input tax credit is also quite extensive. Now, just to understand that in spite of such a wide scope, what are the possible gray areas? I have just picked up an advanced ruling of Orissa in the case of National Aluminium Company 2019-71 GSTR 1, where number of questions were raised regarding admissibility of input tax credit. I have just picked up two examples to highlight the contours of the provision. One of the items for which the advanced ruling was sought was plantation within the mining area. So the SSE had a mine, it owned a mine. Maybe due to government regulations or in furtherance of corporate social responsibility, it was undertaking plantation within the mining area itself, within the factory premises itself. Question was asked whether if GST is paid on this activity, suppose I hire a contractor for maintaining the garden, etc., and he charges GST from me, whether I am entitled to input tax credit. The advanced ruling authority holds that yes, that is an activity which is being taken place in the factory premises itself, and therefore it is in the course or furtherance of business, you are entitled to input tax credit. Second, another question which was raised was regarding gardening in the residential colony for employees. So it was a big factory. It had also developed a residential colony where its employees would stay, and for beautification or for maintenance of that colony, certain expenses were incurred and GST was paid on those expenses. While answering the question with regard to admissibility of input tax credit on such expenses, the authority says that no, that is not directly related to your business, and therefore we'll hold you are not entitled to input tax credit. So this is a view which is likely to be canvassed by authorities in many cases, where the peripheral activities, the authority may take a view that this is not directly related to your business activity, so we will not grant you input tax credit. According to me, this seems to be erroneous. As I said, the scope, the language of the provision is extremely wide. And so if it is a business expenditure and not a personal expenditure, and if it is not coming within the restrictions imposed in the subsequent sections of GST, then according to me, input tax credit should be admissible. So there is no need to apply the test of whether the expense is directly related to the business or whether it is indirectly related to the business. So far as it is in the course or furtherance of business, I should be entitled to input tax credit of that GST. Next, we go to the provision which practically creates the most difficulty regarding ITC mismatch. Now, in common parlance, we are used to use of phrases such as mismatch in GSTR 2A, etc., and its implication. But from the legal point of view, if we try to search out the provision from which all these forms and verifications flow, then the basic provision is contained in section 16, subsection 2, clause C. I may just clarify that 16 subsection 2 enlists four basic conditions for claim of input tax credit. I am not going to go into all of them. I'll just pick up the conditions which are likely to create controversy. So 16 subsection 2 clause C says, subject to the provisions of section 41, the tax charged in respect of such supply has been actually paid to the government either in cash or through utilization of input tax credit admissible in respect of the said supply. Now, it is very important to understand that the legislature says that you will be entitled to input tax credit of tax charged which has been actually paid to the government. So your vendor should have actually paid the tax to the government for you to be entitled to input tax credit. Not only that, it goes a step further and it says that such payment should be either in cash or through utilization of admissible input tax credit. So the common misnomer which is prevalent is that if my transaction is matching in GSTR 2A, then how does the officer have the authority to disallow the input tax credit? But the officer draws his power from this provision. Even though my transaction may be matching in GSTR 2A, that only means that my vendor has disclosed the transaction in his returns. Maybe in the column where it is specified that whether tax is paid or not also, it may come as yes. But suppose on further scrutiny of my vendor's return, it is established that the tax liability which he has discharged is by availing false input tax credits and not admissible input tax credits, then the tax in respect of that supply transaction is not actually paid as per section 16 subsection 2 clause C, and therefore even though the transaction is reflected in my GSTR 2A, even then the officer can come forward and say that no, I will not allow you the input tax credit. So mere matching in GSTR 2A cannot be conclusive proof of claim of input tax credit. It at best creates a rebuttable presumption. So generally the officer should believe that tax would be paid. But if on scrutiny it is found that the vendor has done some mischief and he has not actually correctly paid the tax, then he would be within his rights to disallow my input tax credit. Conversely, merely because there is a mismatch in GSTR 2A, that does not ipso facto mean that I am not entitled to input tax credit. Mismatch in GSTR 2A may be due to n number of reasons, but ultimately if I am able to prove that the tax in respect of my transaction is actually paid, then as per this provision, I will be entitled to input tax credit. So now the next question that would arise is that whether the legislature can enact such a provision whereby even though I am a bona fide purchaser, I have purchased goods from or I have availed services from a registered taxable person. The registered taxable person has admitted those transactions in his returns. He has in fact even shown that the tax is paid in with his returns. If the transaction is reflected on the online portal in the form GSTR 2A. Despite this, whether the legislature can provide for a provision disallowing input tax credit on the ground that there is a default on the part of my vendor. In other words, because the vendor has claimed false input tax credits, whether tax credit can be disallowed or not would be the moot question. Now, in this regard, we need to refer to two judgments one is of Bombay, another is of Delhi. Both are contradictory, and that they will clarify as to how this provision is likely to be interpreted in future by courts. In both these provisions, the constitutional validity of similar provision under the Delhi VAT Act and the Maharashtra VAT Act was challenged. So first and foremost, if we want to say that we are entitled to input tax credit despite default by the vendor, we can't say that before the adjudicating authority. Adjudicating authority is bound by the statutory provision. We would have to challenge the constitutional validity of the provision before the High Court. In Maharashtra, when a similar provision was challenged before the Bombay High Court, the Bombay High Court gave an elaborate judgment wherein it took a view that when the seller collects tax from the purchaser, that is only by way of a contractual sale price, and therefore if seller does not deposit that tax with the government, government is well within its rights to disallow the set-off or input tax rate to the purchaser. So Bombay High Court takes a view that such a provision is valid and government is within its rights to impose such a condition. Per contra, Delhi High Court in the case of on-quest merchandising, where the citation I have given in my slide, takes a view that such a provision is discriminatory, arbitrary, and violating Article 14 of the Constitution of India. Delhi High Court takes a view that if I am a bona fide purchaser, then I cannot be penalized for the default by the defaulter, that is the seller. That would be discriminating between two similarly placed bona fide purchasers, which is not permissible. So Delhi High Court takes a view which is contrary to the Bombay High Court. We are yet to receive any judgment on interpretation or on testing of validity of the provision under the GST law. But as law progresses, as petitions are filed, then we'll get to know the correct analysis of the provision. But for that, we'll have to wait. For the time being, if they are minor claims, then we have to live with this provision. If our seller defaults, if he is found to be fraudulent, bogus, then we'll have to bear the consequences and we'll have to pay back the amount of credit. Next, we move to the provisos to section 16 subsection 2, more particularly the second proviso. Second proviso to section 16 subsection 2 says, provided further that where a recipient fails to pay to the supplier of goods or services or both, other than the supplies on which tax is payable on reverse charge basis, the amount towards the value of supply along with tax payable thereon within a period of 180 days from the date of issue of invoice by the supplier, an amount equal to the input tax credit availed by the recipient shall be added to his output tax liability along with interest thereon in such manner as may be prescribed. Now, this is a provision, in fact, which was enacted even under the service tax regime for the benefit of the suppliers or the service providers. What used to happen was that in many cases, as soon as the seller or the supplier of service raises the invoice, he has a tax liability. He has to pay the tax. Now, if suppose the buyer does not make payment of consideration to the seller or to the provider of service, then the seller or the supplier would have to suffer, because he will have to pay the tax from his own pocket. Not only will he receive the tax amount from the buyer, he will also not receive the amount of consideration from the buyer, and still he'll end up paying tax, because ultimately this tax is on accrual basis. So irrespective of whether I actually receive the amount towards my supply or not, I have a tax liability. And despite he having not paid to me, he will get credit of the tax which I have deposited into the government from my own pocket. So this was an incongruent situation, and therefore such a provision is enacted which says that if the buyer does not pay to the seller within 180 days from the date of the invoice, then the buyer will have to reverse the input tax credit. In other words, it puts a check on the buyer. It tells the buyer that, look, you pay within 180 days. If you don't pay within 180 days, and if you have claimed input tax credit in respect of that transaction, you will have to reverse it. and that too with interest. The third proviso thereafter says that if and when you make the payment, you will be again entitled to tax credit. Now, two issues arise in interpretation of this provision. First, whether I as a buyer need to reverse the input tax credit if my seller gives post-sale discount to me. Now, if you look at the valuation provisions which are contained in section 15, while discount which is given at the time of sale or which is agreed beforehand, then that is admissible as a deduction to the seller from his invoice, from his transaction value. If it is a post-sale discount, that is a discount which is agreed upon and given only after the transaction of sale is over, then such discount is not admissible by way of deduction from the transaction value of the seller. For example, if say A sells goods to B for rupees 100, at the time of sale there is no discussion, no agreement of any discount. 2 months later, suppose COVID situation steps in, the buyer says that, look, now the situation is different, I have a financial crisis, kindly give me some deduction. The seller also feels that the situation demands some consideration and gives a discount of 10 rupees. That discount was not understood at the time of sale. It is a post-sale discount, and therefore the seller will have to pay tax on 100 rupees despite the fact that he gets only 90 rupees from the buyer. Now, question is that because the buyer only pays 90 rupees, but the seller pays tax on 100 rupees of say rupees 10. We take an example of tax rate of rupees 10%. So seller pays 10 rupees of tax, buyer pays consideration of only 90. Whether the authority can rely upon this provision to hold that, look, you have paid only 90 rupees to the seller, you have failed to pay the remaining 10 rupees to the seller within 180 days. So I'll disallow the input tax credit to the extent of 1 rupee. The Tamil Nadu Advanced Ruling Authority in the case of MRF Limited 65 GSTR 11 takes a view that yes, based on such a provision, the input tax credit can be disallowed. According to me, such disallowance is misconceived. The provision says that there has to be failure to pay to the supplier of goods or services. For there to be failure to pay, there has to be a contractual liability. Now, as soon as the seller and the buyer agree for a post-sale discount of 10 rupees, there ceases to be any contractual liability of the buyer towards the seller, and therefore, according to me, the provision would not be invoked. And it would, the interpretation as canvassed in MRF is in fact contrary to the purpose of the provision also. As I started by saying, it is for safeguarding the interest of the sellers. Now, if the seller and the buyer mutually agree to reduce the consideration, then for such mutual agreement, this provision is not invocable. And even though the buyer has paid only 90 rupees to the seller, he will be entitled to full input tax credit of the tax paid by the seller. Next, and again, very interesting question is in the context of retention money. This is also of practical importance. So suppose there is a contract for 1,000 rupees. The buyer makes payment of 900 rupees within a period of 1 month. Some work is remaining towards the contract and therefore the buyer retains 100 rupees. Invoice is already generated on the first day. Thereafter, the entire thing goes into a dispute and for more than 180 days, the buyer does not make payment of that 100 rupees as retention money. Question is whether this provision is invocable or not for disallowing credit to the extent of that 100 rupees. Answer is yes. Because buyer did not pay 100 rupees on his own, there was some dispute, he retained that 100 rupees, but it is payable as per the contract, and therefore, since it is payable and he has failed to pay within 180 days, he'll be liable for disallowance to the extent of the 100 rupees. But the more interesting question is, what if the contract itself provides for a stipulation that look, 10% of amount you can pay after completion of the contract? According to me, here there is a problem. Suppose the buyer and the seller mutually agree for a credit period of more than 6 months for whatever reason, then the provision has a lacuna, because the provision does not give credence to the credit period which is given by the seller to the buyer. The provision simpliciter says that the payment needs to be made within 180 days from the date of issuance of invoice. So according to me, this is a slightly gray area. Even here we can say that ultimately if contractually I was not liable to pay within 180 days, then how can I be expected to make that payment? But still, according to me, here the authority can trouble you, and therefore to save any litigation and difficulty, we can adopt the course of reversing input tax credit at the first instance on the expiry of 180 days. Then whenever we make the payment, we can reclaim the credit. Otherwise, this is likely to lead to some litigation. Next, we move to section 16, subsection 4, which is imposing time limit for the claiming of input tax credit. The provision says a registered person shall not be entitled to take input tax credit in respect of any invoice or debit note for supply of goods or services or both after the due date of furnishing of the return under section 39 for the month of September following the end of financial year to which such invoice or invoice relating to such debit note pertains, or furnishing of the relevant annual return, whichever is earlier. So the provision says that you need to claim input tax credit latest by the due date of furnishing of return for the month of September following the end of the financial year, or the furnishing of annual return, whichever is earlier. First question, whether this time limit is directory or mandatory. In other words, if I skip claiming of input tax credit within the statutory period, whether I can say that, look, no, ultimately I am entitled to credit as per the other provisions or the substantive provisions of the GST law. So this is merely a procedural provision. So I cannot be denied the input tax credit on the ground that I did not claim it within the mandatory period. According to me, here, a recent Supreme Court judgment in the context of Tamil Nadu Value Added Tax Act is directly against such proposition. That citation is ALD Automotive Private Limited versus Commercial Tax Officer, 2019, 13 SCC 225. Supreme Court takes a view that input tax credit, as I said earlier, is arising from the statute itself. The legislature is free to impose conditions for availment of input tax credit. Therefore, if the provision says that he shall not be entitled to take input tax credit after a particular period, it is a mandatory provision and not a directory provision. Supreme Court gives a reason for saying so. Supreme Court says that the intention behind such a provision is that if an SSE is allowed to make belated claims of input tax credit, then there will be questions of how these claims can be verified. So the legislature has put a time cap for claiming of input tax credit, and since the provision is there in the statute itself and not in the rule, we cannot hold that it is directory. The Supreme Court says that it is a mandatory provision. So if you skip claim of input tax credit within that mandatory period, you will not be allowed the tax credit. So we cannot be lax while putting up our claims. In fact, under the earlier regime, if you look at the VAT law in Gujarat, the input tax credit could be claimed even in assessment, it could be claimed even in appeal, and there were judgments to the effect that there is no restriction in doing so. Now all these are things of past. There is a specific statutory provision putting up a time limit, And Supreme Court in case of similar provisions has held that it is a mandatory provision. You cannot skip the deadline. So we need to claim the input tax credit within the time limit as stipulated under section 16(4). Now here, a more interesting question or a more interesting issue is because of this advent of GSTR 3B right from 1/7/2017. Now, as we know, originally it was planned that the returns would be in GSTR 1, 2, and 3. 3B was only sort of a stopgap arrangement in lieu of GSTR 3. But as things unfolded, it was found that this 3B itself and the system itself right now is not very smooth, and therefore the government has yet not implemented that GSTR 1, 2, 3, etc. Now, in the context of GSTR 3B, a writ petition was filed before the Gujarat High Court in the case of App and Company versus Union of India, making a claim that look, GSTR 3B is only a sort of a stopgap arrangement statement. It is not a return, and therefore kindly hold that we are entitled to input tax credit even beyond the date which is stipulated in section 16(4), or at least we should be able to claim the input tax credit till the filing of annual return, because 16(4) gives two deadlines, whichever is earlier. One is relating to the return for the month of September following the end of the financial year, and second is annual return. So the contention before the High Court was that there is no monthly return for the month of September. 3B is not a return, and therefore I should be allowed to claim input tax credit till the filing of annual return. The Gujarat High Court took note of Rule 61 of the rules, where there was an amendment which was made at the time of introduction of the GST regime itself. Initially, in the rule, it was mentioned that GSTR 3B is in lieu of returns, is in lieu of GSTR 3. This phrase "in lieu of" was specifically dropped after a month. So High Court gave credence to this particular amendment and took a view that yes, 3B is not a return, it is not in lieu of GSTR 3, and therefore it cannot be said that you are bound to claim input tax credit up to filing of 3B for the month of September of the subsequent year. Apart from challenging this judgment of Gujarat High Court before the Supreme Court, the government did another thing. It immediately on the 9th of October 2009 retrospectively amended Rule 61 Subrule 5, which is regarding this 3B. And it was expressly clarified in the provision itself that 3B is a return. So if we look at the amended Rule 61 Subrule 5, it clearly emerges that 3B is a return. Moreover, this amendment was given retrospective effect from 1st of July 2017. In other words, according to the government, 3B was a return right from 1st of July 2017. And therefore, the very basis of the judgment of Gujarat High Court in App and Company was sought to be removed. Now, in light of such chain of events, the question is that for the years 17, 18 and 18, 19, that is the years prior to this amendment, what would be the position, what would be the time limit for claiming input tax credit? Because now there is a retrospective amendment made in Rule 61 Subrule 5, the authorities are likely to take the view that even for the year 17, 18, 18, 19, if you did not claim the input tax credit by the month of September following the subsequent year, you will not be entitled to input tax rate. Of course, in 17, 18, it was extended for some months, I believe up to March of 2019. That is a different procedural aspect. But per se, the authorities are likely to take a view that now 3Bs are returned right from 1st of July 2017, and therefore we will invoke this provision for claims right from the beginning. according to me, here there is some scope for argument and challenge to the validity of such a retrospective amendment, relying on what I had said at the beginning, that input tax credit is a right granted by the legislature. Once it is granted, it cannot be taken away retrospectively. So the contention can be that, look, like the Gujarat High Court, I too believed that there is no monthly return. I believed that we could claim input tax credit till the filing of annual return. One fine day, much after the expiry of time period for the filing of monthly return for the month of September, you come up with a retrospective amendment and declare 3B to be a monthly return, thereby taking away my right of input tax credit with retrospective effect, which is not valid. So according to me, for the year 17-18 itself, this is a good proposition. For the year 2018-19, there is a slight hitch. If you look at the date of the notification, date of the retrospective amendment, it is 9th of October 2019. While the due date for furnishing of return for the month of September 2019 would be 20th of October 2019. So for 18-19, the authority or the court can say that, look, you still had some time period for claiming of the input tax rate for 18-19, you should have immediately claimed. Here too, we can say that, look, we believed that we had time up to filing of annual return. Suddenly, the government cannot come up and say that within 10 days, you calculate all your claims and claim the credit. Therefore, for 18-19 also, there is a chance for saying that we should be allowed to claim input tax credit till the filing of annual return. But insofar as the subsequent years are concerned, from 1920 onwards, now, according to me, there is very less scope for any argument. If we miss the bus, if we don't claim the credit by the monthly return of September, then we will lose that credit forever. So we need to be very, very careful while computing our credit claims, and at least by the end of September, we should have everything clear and all possible claims should be put forth. Another difficulty or another problem which I foresee with this provision is in genuine cases where, suppose I had claimed an exemption. So I claimed, suppose I am manufacturing only one commodity and I believe that that commodity is exempt from tax. Because it is exempt from tax, I do not claim input tax credit in respect of the inputs or input services. In adjudication, after say 2 years, the authority comes to a conclusion that no, these are not exempt goods, these are taxable goods. Question is then, what about the input tax credit? According to me, this will be a genuine problem. We'll have to fight it out. We'll have to say that if I believed they were exempt and if I had a case for saying so, if ultimately they are held to be taxable, then I should be granted input tax credit. I cannot be denied input tax credit on the ground that you did not claim it within time. At the time of filing of return, I believed that I was not entitled to, and therefore I did not claim. Now, if you hold that I am not entitled to exemption, and therefore I will be entitled to input tax credit, then I should be granted irrespective of the time limit. But this is an issue of litigation not likely to be resolved at the departmental level. The adjudicating authority, if he denies you the exemption, he will also deny input tax credit on the ground that the time period for claiming the input tax credit has already elapsed. Connected with this issue of time limit under 16(4) is the issue of transitional credit. Now, Section 140 contains a number of subsections which allowed us to claim transitional credit when we transited from the earlier regime to the GST regime. When GST was incorporated, the sections per se did not have any time limit for claiming such transitional credit. The sections also did not ever say that it should be claimed within the prescribed time period. However, Rule 117 provided for a time limit for filing of the Form Tran 1, which was extended once, but thereafter there was no further extension. questions arose across the country. What if for any reason I missed filing of that Tran 1? Whether I will lose that transitional credit forever. Gujarat High Court initially in the case of Willowwood Chemicals Private Limited versus Union of India, 58 GSTR 310, took a view that Rule 117 is enacted under the general rule-making power given to the government. Ultimately, Gujarat High Court also adopted the same reasoning as adopted by Supreme Court in ALD Automotive and said that if we allow the SSEs to claim the transitional credit at any point of time, there will be major practical issues of verification of the claims, and therefore Gujarat High Court took a view that no, we hold that the time limit for filing Tran 1 is mandatory. If you skipped filing of that form within the stipulated period for whatever reason, then you will lose the benefit of credit. Subsequently, Gujarat High Court, another coordinate bench in the case of Siddharth Enterprises versus Nodal Officer, 71 GSTR 346, without noticing that judgment of Willowwood Chemicals, independently came to a view that no input tax credit is a right vested in the SSE. The statute does not provide for a time limit for claiming transitional credit, and therefore the time limit which is prescribed under the rules is only a directory time limit, and even if you miss that time limit, still you can be entitled to input tax credit under section 140. Another subsequent development was that thereafter government filed a review application against the judgment of Siddharth Enterprise on the ground that it was contrary to the earlier judgment of Willowwood Chemicals. Gujarat High Court has recently dismissed the review application on the ground that they stick to the judgment which they delivered, and according to them, Willowwood Chemicals was not correctly decided, and it did not take into consideration the correct aspects that input tax credit is a vested right in the SSE. Following Siddharth Enterprises, there have been number of judgments by different high courts, one being Punjab and Haryana in the case of Adv Technologies Private Limited, another of recent judgment of Delhi High Court in the case of Brand Equity Treaties Limited versus Union of India, all taking views that Rule 117 is a directory provision, and therefore you can claim input tax credit even beyond that period. In fact, Delhi High Court goes to the extent of holding that ultimately the claims would be governed by the Limitation Act, and therefore if you claim within 3 years from 1st of July 2017, you should be entitled to the transitional credit. Of course, all these issues are now lying before the Supreme Court. Against Punjab and Haryana judgment, SLB is dismissed, but it is only a simpliciter dismissal of SLB, and it would not be a binding judgment of the Supreme Court. The Delhi High Court judgment stands stayed by the Supreme Court, so Supreme Court will ultimately decide whether it is correct or not. For the time being, for Gujarat at least, Siddharth Enterprises holds the field. But now the interesting subsequent development is the retrospective amendment of section 140 of the GST Act by the Finance Act 2020. In all the subsections of section 140, the phrase within such time has been introduced. So while earlier the provision did not talk about any time limit, now by the Finance Act 2020, with retrospective effect from 1st of July 2017, all the subsections have a phrase that it should be within such time as may be prescribed. So first question is, what is the effect of this retrospective amendment? According to me, now the judgment of Siddharth Enterprise and the other favorable judgments will have to be tested after the retrospective amendment. The court can take a view that now that the law is retrospectively amended, we will not go by what we earlier decided. We went by the fact that statute did not provide for a time limit, but only the rule gave a time limit. Now, because the statute itself says that it has to be within the time as may be prescribed, we will say that it is a mandatory time limit. Second question, whether such a retrospective amendment is constitutionally valid or not. Now here, according to me, again that principle can be pressed into operation, that if earlier you did not provide for a time limit in the statute, you only provided for a time limit in the rules. That time limit was held by the high courts to be directory. Thereafter, with retrospective effect, you make an amendment in 140, which is impossible to comply with, because you have amended 140 and provided for a time limit much after the expiry of that time limit. Therefore, it is impossible, virtually impossible to comply with the retrospective amendment, and therefore it takes away my right of input tax credit, which I was entitled to as per the various high court judgments, and therefore this retrospective amendment is arbitrary and therefore violating Article 14 of the Constitution of India. But according to me, again, this will have to be tested, likely to be tested soon by different high courts, and if the retrospective amendment is held to be arbitrary, then again the earlier judgments would prevail and we can say that the time limit was directory. Third issue is that whether retrospective amendment will have any effect on the notifications which allowed extension for technical glitches. No. Although the statute provided that it has to be within the time limit, if the government by notification extends the time for cases where there were technical glitches, then according to me, those would continue to be governed by the notification. If it is found that there was a technical glitch, then the SSE should be entitled to input tax credit. And the last question is regarding what if there were bona fide errors in the Tran 1. Suppose the Tran 1 was filed within the statutory time limit, but there was a bona fide error, not in terms of missing out of the credit, but we have come across many cases where suppose the column in which the amount should have been mentioned, that is a wrong column. Only the amount of the value of goods is mentioned and not the tax amount, etc. Question is whether these cases the credit is admissible. Here, according to me, there are a couple of judgments. One of Gujarat High Court itself in the case of Jacob Methane Private Limited versus Union of India, an unreported judgment, where Gujarat High Court takes a view that if it is a bona fide error, then the SSE should be given a chance of revising the Tran 1, even if the time limit for revision has expired. So, according to me, if there was a bona fide error in the Tran 1, then the credit should not be lost. But if the Tran 1 was not filed at all, and that too not because of a technical glitch, then still there is a long battle ahead. Next, we go to section 17, which provides for certain circumstances where the input tax credit is required to be reduced, or where input tax credit is not available. First is section 7, we'll go to section 17 subsection, I'm sorry, it's not 1, it should be subsection 2. 17 subsection 2 says where goods, I have just extracted the gist of that provision. It says that where goods or services are used partly for effecting taxable supplies and partly for effecting exempt supplies, then the amount of credit shall be restricted to so much of ITC as is attributable to taxable supplies. So if I am manufacturing a taxable commodity and an exempt commodity, and if I have common pool of input tax credit, then I will get the input tax credit only to the extent it is attributable to my taxable supply. Now, two issues which are likely to arise. First, whether input tax credit is required to be reversed in case of byproducts and waste products. In many cases, the byproduct and waste product are exempt commodities, while the main product is a taxable commodity. Question is whether this provision is attracted or not. According to me, insofar as byproducts are concerned, this provision will definitely apply. Insofar as waste products are concerned, it is a debatable proposition. What would be the difference between byproduct and waste product? It would be a question of fact. If it is a major product, if suppose I am manufacturing, I'll take the example which was taken by the Supreme Court in the decision which I have cited. If I am manufacturing, say, oil from cottonseed, and I also incidentally or I also simultaneously manufacture oil cake. Oil is taxable, oil cake is exempt. Question is whether I need to reverse input tax credit towards attributable to oil cake or not. SSE took a stand that no, all my inputs went towards manufacture of oil, I only intended to manufacture oil. Oil cake was only a byproduct, and therefore no proportionate reversal of input tax rate was required. Supreme Court in the case of State of Karnataka versus MK Agrotech Private Limited, 2017-16 SCC 210 takes a view that look at your proportion of sale. While you may say that the oil cake is a very minor product, if you look at your proportion of sale, almost more than 30% of it is for oil cake. So we cannot subscribe to the view that oil cake only is only an incidental product. It is a byproduct, and therefore you need to reverse the input tax credit proportionately. Per contra, in the case of Arya Lumbers Private Limited versus State of Gujarat 2017-19 VST 146, question was with respect to firewood. So big timber logs were sawn into small timber logs, and the waste which was generated in the process of this sawing was sold off as firewood, which was exempt from tax. The proportion of this firewood was merely 1% of the total process. Gujarat High Court takes a view that this is only incidental generation of waste product. It cannot be said that the inputs were used partly for taxable and partly for exempt goods, and therefore the Gujarat High Court takes a view that no need of reversal of input tax credit. So there is a very thin line of distinction as such, and it is an issue which is likely to rake up controversy. So according to me, the safe course in such cases is that if there is taxable and partly exempt product, then we need to proportionately reverse input tax credit to the extent of the exempt product. For waste product, a contention is available, but that is slightly risky. Second question, what if the intermediate product is exempt and the final product is taxable? For example, captive power plant or windmill used for generation of captive electricity. Electricity is exempt from GST, but I don't sell off the electricity. I use it further in manufacture of my commodity, which is taxable. Question is whether the input tax credit can be disallowed under this provision on the ground that I used the raw material for manufacturing of electricity, which is exempt, and therefore I am not entitled to input tax credit. According to me, if you read the provision, it says where goods or services are used partly for effecting taxable supplies and partly for effecting exempt supplies. So the determinating factor is that it should be used for effecting a taxable supply and effecting an exempt supply. If I generate electricity and use it captively in manufacture of my own product, I do not supply the electricity at all. I may be manufacturing the electricity, but I do not supply the electricity, and therefore the goods or services are not used partly for effecting taxable and partly for effecting exempt supply. The supply which I make is of the taxable finished product, and therefore no requirement of reversal of input tax credit. There will be a problem in case where suppose my captive power plant is in Gujarat and one of my factories is in say Maharashtra, and I transfer the electricity from Gujarat to Maharashtra. Now, for the purpose of GST, my Gujarat and Maharashtra units would be deemed to be different, distinct persons, and therefore electricity will be supplied by Gujarat to Maharashtra, in which case the authority can take a stand that so for Gujarat, there is no question of there being any taxable manufactured commodity. All you did was supply electricity to Maharashtra, which is exempt, and therefore we will say that you are not entitled to input tax credit. Here we'll have to find a way out, but otherwise there seems to be a problem if the intermediate product is manufactured in one state while the final taxable product is produced in another state. But if everything is in the same state, then there should not be any issue. Merely because intermediate product is exempt, then input tax rate cannot be disallowed if my final product is taxable. Next is regarding the value of the exempt supply for this pro rata reversal under 17.2. I'll just quickly go through this provision because we have paucity of time. So I would like to discuss the more important issues which are there subsequently. Just one thing we need to note here, that 17.3 defines what is exempt supply for the purpose of pro rata reversal. With effect from 1st of February 2019, an explanation was added wherein it was clarified that it will not include activities or transactions which are specified in Schedule 3 except for those specified in Para 5 of the schedule. That is regarding sale of land and completed building. On the very same date, in Schedule 3, high C sale transactions were incorporated. So from 1st of February 2019, high C sale transactions are covered under Schedule 3. Plus, Section 17 subsection 3 explanation says that the value of exempt supply for 17.2 will not include transactions specified in Schedule 3. So in case of high C sale turnover, even though I have no output tax liability, still I will be entitled to full input tax credit. I will not have to include it in my exempt turnover while I compute that formula for reversal of input tax credit. Here, according to me, there is no need for application of any logic where the provision itself is clear. The authority may say that if you are not paid the tax, why should I grant you input tax credit? As I said, ultimately this is a input tax credit is a product of the statute. If the statute deemed it fit that no, for high sale transactions I want to grant input tax credit, then that is the end of the matter and we should be entitled to the credit. There was an earlier advance ruling in the case of BASF Limited 69 GST 341 AAR Maharashtra, which took a view that high sale turnover needs to be part of the exempt supply for purpose of pro rata reversal. But this advance ruling was prior to the amendment which I just talked about, and so that would no longer be good. Now coming to 17.5, which is very important and according to me is likely to raise a lot of controversies. 17 subsection 5 is the provision which enlists certain transactions for which input tax rate is not admissible at all. It is an overriding provision. So despite the fact that the inputs, the goods or services are used in the course or furtherance of business, despite the fact that other conditions under in section 16 are fulfilled, still 17 subsection 5 enlists certain transactions where I am not entitled to input tax credit. Again, as I said earlier, we cannot find fault with that. The legislature can put up any restrictions or conditions for claim of input tax credit. Now we want to highlight subclause C and D, which I have extracted in the slide. C says works contract services when supplied for construction of an immovable property other than plant and machinery, except where it is an input service for further supply of works contract service. D says goods or services are both received by a taxable person for construction of an immovable property other than plant or machinery on his own account, including when such goods or services or both are used in the course or furtherance of business. There is an explanation which says for the purpose of clause C and D, the expression construction includes reconstruction, renovation, addition or alteration or repairs to the extent of capitalization to the said immovable property. Now the first issue here is what is the scope of the phrase for construction which is used in clause C and D. Clause C and D says work contract services when supplied for construction of an immovable property. D says goods or services or both received by a taxable person for construction of an immovable property. So what is the scope of this phrase for construction? We'll just take an example of a West Bengal advance ruling in the case of GGL Hotel and Resort Company Limited, 2019-71 GST 577. Question here was if I have paid leasehold land premium, whether I am entitled to input tax credit or not. The West Bengal authority takes a view that that leasehold land is used as the base for construction of the factory, and therefore the tax paid on the leasehold premium is for construction of an immovable property, and therefore no input tax credit is admissible. According to me, this is an incorrect ruling. The phrase for construction cannot be interpreted in such a manner when the provision says for construction of an immovable property, it has to be directly related to the construction of immovable property. The leasehold premium which I pay is only for getting the leasehold land. It has nothing to do with the construction activity of the immovable property, and therefore I should be entitled to input tax credit on the leasehold premium. Suppose I have already set up my company. I have engaged certain consultants, certain auditors, certain lawyers, etc. And I am paying GST on those services. Again, according to me, these are not services used for construction of an immovable property. Merely because at that point of time the construction is going on, that cannot be said to be a service for construction. If I have suppose engaged a technical engineer for getting some certificates, then it is a service which is directly for construction of immovable property, for which I will not be entitled to input tax credit. But according to me, it cannot be given a wider meaning. Second issue is whether such a provision restricting input tax credit in respect of capital goods is valid or not. Now here this issue is in the context of a judgment of Orissa High Court in the case of Safari Retreats Private Limited, the first citation which I have given, where the Orissa High Court takes a view that was in the context of a commercial mall, where Orissa High Court takes a view that ultimately if on the renting of the mall you are paying output tax liability, then you should be given the benefit of input tax credit also, and therefore these provisions of clause C and D were read down by the Orissa High Court. According to me, it is a very cryptic judgment, unlikely to be sustained before the Supreme Court, and therefore very risky to claim credits on such grounds. As I said, legislature can provide for conditions. We cannot say that because we are paying output tax liability, we should be mandatorily granted input tax credit of all the inputs, input services and capital goods. So I have framed the issue based on the judgment, but according to me, that judgment should not be relied upon for the present. Third issue which I have framed is what is an immovable property. Now this dispute is going on since a long time. Even in the earlier regime, there were judgments on this aspect. And this will continue even now. I have just picked up an advance ruling in the case of WeWork India Management Private Limited of Karnataka. Here, question was regarding claim of input tax credit in respect of partitions which were developed in the office, as well as detachable wooden floorings. The advance ruling authority takes a view that while partitions have a permanent feature in the office, so they will form part of the immovable property. Insofar as the wooden flooring is concerned, that is completely detachable, and therefore the authority took a view that for detachable wooden flooring, the SSE will be entitled to input tax credit. What is an immovable property? There are a number of judgments of Supreme Court in the context of earlier law. A couple of them I have extracted. One is Sirpur Paper Mills. All these are cases where a machine was embedded into the earth. Question was whether this machine becomes an immovable property or whether it remains a movable property. The Supreme Court in number of cases has taken a view that ultimately the degree and mode of the fastening needs to be seen. If it becomes permanently attached, permanently embedded, then it becomes an immovable property. If it can be easily removed, if it is only fixed by nuts and bolts for the purpose of undertaking the process, then it is not an immovable property. So again, all these judgments will be relevant if we are able to prove that no immovable property has been constructed at all. Then we completely get out of this provision and we are straight away entitled to input tax credit. The next question which comes is that suppose it is an immovable property, then what? In the provisions extracted, you would have seen that there is an exception for plant and machinery. So even though the goods and services or works contract services are used in the construction of an immovable property, if that immovable property is in the nature of plant and machinery, then I am entitled to input tax credit. But plant and machinery is very curiously defined in the explanation to section 17. It has been defined to mean apparatus, equipment, machinery fixed to earth by foundation or structural support that are used for making outward supply of goods or services. It includes foundation and structural support, but excludes land, building, or any other civil structure. So, according to me, the moot question, the important issue would be the scope of this exclusion for land, building, or any other civil structure. I have drafted two issues for this. First, again, what is the scope of any other civil structure? Whether machinery which is used, which is installed in the building, such as chiller, air handling unit, lift, escalator, etc., will be treated as part of any other civil structure. Now here, again, Karnataka AAAR Tarun Realtors Private Limited takes a view that if the machineries, the machines such as chillers, lifts, etc., form part of the building itself, then they will become part of the building and therefore they will fall within that exclusion of land, building, and any other civil structure. Per contra, in BAHL Paper Mills Limited, Uttarakhand AAR, the authority takes a view that an AC unit which is installed, that would not be considered to be any other civil structure. But if suppose it is a sanitary fitting which forms part of the building, then it would be part in any other civil structure and you will not be entitled to input tax credit. According to me, this Tarun Realtors Private Limited seems to be incorrectly decided. If it is a machine and if it is embedded into the earth, input tax credit in respect of that machine cannot be disallowed on the ground that it becomes part of the building and therefore you are covered within that exclusion. If we look at the provision itself defines plant and machinery to be something which is fixed to earth by foundation or structural support. So plant and machinery is defined to mean something which is embedded to the earth. So ipso facto, by it being embedded to the building, it does not become part of the building. If it is a machine, you are entitled to input tax credit. But if it is only a building, then you are not entitled to input tax credit. We know in the context of income tax, the Supreme Court has taken the view that even building can be a plant. But for GST purpose, it is expressly provided that land, building, or any other civil structure will not be a plant. So whatever is only housing the machinery, that will not be a plant. But if the machinery itself is embedded, that continues to be a machine and you should be entitled to input tax credit. And second connected issue is that what if suppose that civil structure itself directly contributes in the manufacturing process. This was the case in Satyesh Brainkem Private Limited, AAAR of Gujarat, where bunds were constructed. Bunds were sort of sand dunes which were constructed for manufacture of salt and bromine. So the bunds were part of the manufacturing process itself. They were not housing any machinery. They were part of the manufacturing process itself. However, the AAAR takes a view that whatever it be, it is a civil structure, will disallow input tax. There the matter is now pending before the High Court, where the issue is that whether the exclusion of any other civil structure has to be read adjustem generis with land and building, or it has to be read independently. In other words, any other civil structure has to be read as meaning that it is a civil structure which is only doing the work of housing the office or the plant or the machine, or it has to be interpreted widely to include any civil structure, even if it is directly connected with the manufacturing process. According to me, this second question is slightly tricky. It can go either way. But insofar as the first question is concerned regarding machinery embedded to the earth, according to me, the position seems to be clear. If it is in the nature of machinery, merely because it is embedded to the earth, you cannot say it becomes part of the building and therefore will disallow input tax credit. But of course, we need to satisfy the second condition also, that they should be used for making outward supply of goods or services. So again, they should be in some manner connected with the manufacturing process. Next restriction on input tax rate, which I would want to discuss, is section 17 subsection 5 clause H. Is regarding goods lost, stolen, destroyed, written off, or disposed of by way of gift or free samples. First issue, whether input tax rate is to be reversed in case of buy one get one free offer. So if a shop sells 2 shirts, it says as a marketing strategy that on buying of 1 shirt, you get the other shirt free. Question is whether I get credit of both shirts or only of 1 shirt. Now the CBIC has clarified by circular dated 7th of March 2019 that this is only in the nature of a marketing strategy. Ultimately, the shop does not intend to give anything free. It is only sale of the 2 shirts for 1 price, and therefore you should be entitled to credit for both the shirts. While we may be happy with the circular and it may be a benevolent circular, we should bear in mind that if suppose the commodities are the same, then there is no problem. If suppose it's the question of 2 shirts, there is no problem. But suppose if it is the question, we also, if we go to our common groceries, we find on many occasions that on say purchasing a shampoo, we get another article, say a soap which is free. Now, suppose we go by this logic that it is not free as such, but shampoo and soap both are sold for a common price. Then while we may be entitled to input tax credit on both the products, the supply will become a mixed supply, and therefore if suppose the soap and shampoo are taxable at different rates, then the highest rate would be applicable on the composite, on the total sale price. So we need to be careful that when we take a stand that this is not a gift article, this is not a free article, we are selling both together. And on the basis of such stand, if we claim input tax credit, then on the output side, it will become a mixed supply. Third question is that whether this contention, whether the circular can also help in cases where suppose I give out free samples. Ultimately, the customer approves of those samples and it places an order onto us. And therefore, we take a stand that what we gave was not free. Ultimately, the sample cost was also recovered from the customer. According to me, that is not the purport of the circular. In case of a buy one get one free offer, I do not intend to give anything free. It is buy one get one free, but in substance, I am selling both the commodities. In case of free samples, I intend to give the samples free of cost, merely because subsequently I am able to recover the price of the samples by charging from the customer when he places the order. That is no ground for claiming input tax credit even in respect of samples, particularly if you look at section 17(5)(h), it specifically refers to free samples. So according to me, this buy one get one free circular cannot be extended even to free samples or say gifts given to employees, etc., on the ground that ultimately we recover the cost from our customers. Now we are almost short of time. I'll just deal with a couple of peripheral issues. One is regarding interest under section 50. This is an issue which has been bothering many companies and professionals. The provision says that if a person fails to pay the tax within the prescribed period, the interest is chargeable. Question is that if I suppose failed to pay the tax, I filed a belated return, but I had substantial credit with me and only 10% of my tax was paid through electronic cash ledger. Whether I am liable to interest on 100 or whether I am liable to interest only on 10 rupees. By Finance Act 2019, a proviso was inserted to clarify that the interest will only be on net tax liability. However, by Finance Act 2019, it was sought to be introduced prospectively. So the department continued to issue notices for demanding interest on gross tax liability for the prior period. This proviso has thereafter never been notified. On a plain reading of the provision, Telangana High Court in the case of Mega Engineering and Infrastructure takes a view that the electronic credit ledger gets credited only when you file the return. So you cannot say that at the time of filing of return, because you paid the tax liability through input tax credit, therefore your actual liability is only to the extent of net tax liability. Telangana High Court takes a view that your actual liability is gross tax liability, so you pay interest on the entire amount. Contrary judgment recently by Madras High Court in the case of Reflex Industries. Thereafter, in March, now the GST Council has in principle agreed that it will retrospectively introduce this proviso in the statute. We don't know when all this will happen, but if suppose it is introduced retrospectively, then probably the issue will come to an end. And if we have input tax credit with us and we pay only part of our tax liability in the electronic cash ledger, and if the GST Council amendment comes through, then it will be the end of the matter. But according to me, even if that amendment is not made, if you look at the provision, the interest is leviable only on failure of payment of tax due. So according to me, even on first principle, the Madras High Court seems to be correct. Telangana High Court seems to be erroneous. If I had input tax credit balance, then I cannot be asked to pay interest on the portion of input tax credit. Secondly, it is important to note, if we look at the proviso which is sought to be introduced, it carves out an exception for proceedings under 73 and 74. So even if such a proviso is introduced, the question will remain, if suppose in adjudication I am held to be liable to more amount of tax, and I have input tax credit balance available with me for meeting that tax liability, this proviso will not help me in avoiding interest, because it is applicable only for something which is other than proceedings under 73-74. So if under 73-74 I am found liable to tax, even though I pay that tax out of my electronic credit ledger, the adjudicating authority will charge interest. But according to me, that should not be the correct position. Even without the proviso, as I said, if I have input tax credit balance, I should not be liable for interest. And therefore, even if the liability arises in adjudication, if I have enough input tax credit balance, there should not be interest liability. Here we have support from the Gujarat High Court judgment in the case of State of Gujarat versus Jai Steel and Tube Traders 2015-80 VST 530, where the Gujarat High Court takes a view that if there is sufficient input tax credit balance, then the question of interest and penalty does not arise. So that was basically a sort of an overview of the input tax credit provisions. But although the parent provision is simplified, there are a number of conditions and restrictions to the grant of input tax credit, and therefore as time progresses, we'll have new facts coming up, new case laws developing, and therefore we'll be able to again reanalyze our understanding of input tax credit. But for the time being, as I said, we should be very as professionals, what we need to be very careful about is not missing out on the claim of input tax credit. Whether it is admissible or not, etc., that is an important aspect. But as professionals, it is our responsibility that we don't miss out. It is a mandatory time limit. We need to claim it within the stipulated time period. Thank you all for a very patient hearing. I hope the presentation was useful.
Yes, sir.
Thank you so much, Uchit bhai. Not only presentation, but your analysis and your views about various contentious issues regarding input tax credit and various litigant issues about input tax credit, and your stand on various issues will really be fruitful for all the participants to take stand in their own cases. So we thank you so much from the bottom of the heart, Uchit bhai. Thank you so much. And now I request Advocate Hiren Bhai Thakkar, Honorable Treasurer of Income Tax Bar Association, to proceed for the vote of thanks.
Am I audible? Hello.
Yes, audible.
Okay, thank you. Respected President of all three associations, all respected senior member, and our most valued invited attendees. It's my privilege to have been asked to propose the vote of thanks on this occasion. I, on behalf of Income Tax Bar Association, All Gujarat Tax Federation Association, and CA Association Ahmedabad, let me call it is a very much interesting this all three associations here together. And on my own behalf, extend a very heartily vote of thanks to Speaker named Adv Uchit Sheth for gracing your important work and sharing with us your findings and opinion today. A big thank you to Advocate Uchit Sheth for his efforts toward input tax credit under GST topic. Refer and response to just one central idea that we found particularly interesting. Finally, I would like to take this opportunity to place on record our heartily thanks to all our president of all three associations and all respected members. Thank you all of you.
Thank you, Hiran bhai. Uchit bhai, if you permit, one question has been received regarding your session. So if you can permit, only one question is received. I can read the question. It is from Sri R.D. Chomal. Our one of client is doing business of export of fish with LUT, MEIS license sale related to zero rated supplies and exempt supply. My question is whether we have to reverse ITC of MEIS license sale, and if yes, then in which proportion?
Yes, so it appears that this MEIS license sale is an exempt supply, while the main supply is taxable. So according to me, if that is the fact, then we need to reverse the input tax credit proportionately. As I said, a view can be canvassed that ultimately whatever my goods and services are going towards the main activity of fish, they are not going towards this MEIS license, and therefore I'm not using it partly towards taxable and partly towards exempt. But that is an issue of litigation, and so if we want to avoid it, then proportionate to my license sale turnover, we should on the safe side reverse the input tax rate to that extent. And the proportion is mentioned in the rule itself. We need to apply the formula, include the turnover of exempt supply, and accordingly restrict the input tax rate.
Thank you so much, Uchit bhai. Participant has requested the presentations of honorable experts. So we will definitely share the presentation. And once again, thank you so much, Uchit bhai, for sparing your valuable time. Now we are going to complete another fantastic session on GST. So now we will meet on 31st July with another webinar session. Thank you very much. We are ending with this session. Thank you.
Thank you.